The advent of high inflation in 2022 marked the end of the period marked by extremely low interest rates and quantitative easing. For the time being, this change has disproved earlier theories about the economy and the markets. Central banks won't support harmed markets any longer. Selling speculative assets is no longer a surefire way to become wealthy, as Sam Bankman-Fried of FTX has discovered. It's a brand new world. This has led to anxiety among the common man regarding finance. Let us look into some of the reasons that led to such a dire situation. The unanticipated increase in inflation is the root cause of this turmoil. The Federal Reserve raised the federal funds rate by 4.25 percentage points to a level last seen in early December 2007. The Bank of England raised rates by 3.25 percentage points to a level last exceeded in November 2008, and the European Central Bank raised rates by 2.5 percentage points to a level last seen in December, with the Bank of Japan being the notable exception. Bond yields have increased as well. The yields on 10-year gilts, German bonds, and U.S. Treasuries have all increased since the end of December 2021 by more than 2.6 percentage points, 2.2 percentage points, and 2.3 percentage points, respectively. By longer-term norms, rates are modest, but since early 2011, U.S. yields have not been this high. Real rates have also increased. The yield on U.S. 10-year Treasuries that are inflation-protected has increased over the past year, from 1% to more than 1.5%. Inevitably, rising rates have caused asset prices to become unstable. The year ended with stock markets that were noticeably volatile, but far from being cheap. By the end of 2021, Bitcoin had dropped from $65,000 to around $16,600. Will there be uncertainty in the coming years? The main concerns, outside those related to geopolitics and energy, are inflation and monetary policy in the future. Monetary policy in the significant jurisdictions is likely to loosen before the end of the year if inflation quickly declines. It won't happen if it doesn't. High-income nations will also put pressure on highly leveraged ventures. Recessions, according to Austrian economist Joseph Schumpeter, result in creative destruction. At the very least, expensive cash will serve as a necessary reminder that using leverage is never a one-way bet. The longer-term question is whether the free money period is passing through a blip or coming to an end permanently. In The Great Demographic Reversal, Charles Goodhart and Manoj Pradhan, among others, make the case that demographic dynamics would eventually lead to increased inflation and interest rates. Olivier Blanchard, a former IMF senior economist, contends that once the current inflationary shock has passed, the dynamics that have led to low real interest rates on safe assets will still be in control. Let us take a look at how the end of free money has caused trouble. The tech sector has been characterized for more than 10 years by two economic zeros. Due to the zero interest rate policy implemented throughout the Western world, the cost of money fell precipitously, allowing startups to operate at a loss for several years and piquing investors' interest in taking enormous risks that could result in significant rewards. However, the zero marginal cost of the software sector allowed for circumstances like WhatsApp, which had 55 employees serving 420 million users before being acquired by Facebook for $19 billion. But both of those circumstances are ending. The growth of AI technologies poses a danger to the production model that has enabled the sector to achieve its current dominance, while governments around the world have increased interest rates in a last-ditch effort to contain post-pandemic inflation. And as a result, the coming decade may be substantially different from the previous one. What is the ZIRP, zero interest rate phenomenon? Interest rates didn't exactly reach zero in most of the Western world, but they were lowered to such low levels that they didn't matter when inflation and GDP stagnated following the Great Recession. In the United States, the Federal Reserve slashed interest rates to 0.25% in 2008 and left them there for 7 years. Then, gradually raising them to 2.5% in 2018, they progressively decreased to nearly zero in the midst of the epidemic. The rate in the UK was reduced from 1% to 0.5% in 2009, and it didn't go back to its previous level for the following 13 years. An economic digression. The economy is significantly impacted by central bank interest rates in two ways. They effectively represent the cost of money, on the one hand. When you borrow money, you must pay interest on it. If the interest rate is low, you pay less for your money and can borrow more of it for the same cost. However, they also offer a benchmark risk-free rate of return to investors. Your assurance of repayment when loaned to a central bank places a ceiling on possible investments. Zero interest rates are a very low floor, which encourages investors to chase after riskier ventures that might pay off. Therefore, low interest rates encourage more investment overall, open up credit, and perhaps jumpstart a stagnant economy. However, that broad push has extremely specific effects in the tech industry. The venture capital ecosystem, one of the few legitimate financial products that tries to offer a 1,000-fold return on investment, grew wealthy due to the poor rates of return from conventional investments. Yes, the risk was significant, but given the low interest rates, it was a gamble worth taking. Additionally, the influx of foreign investment was patient. Rates were low, therefore it didn't matter if the return was a year or 10 years in the future. A company that could guarantee millions of dollars in 5 years was far more alluring than one that would only make a small, sustained profit the upcoming quarter. The consequences continue to spread. Because of its tremendous advertising revenue, which is largely generated by firms with venture capital funding paying astronomical sums to recruit customers at a loss as they scramble to expand. However, ZERP is over. High interest rates and a declining cash supply are both problems. What does the business's marginal cost look like, and how does it impact it? Marginal cost is the other zero after that. The price of producing one additional unit of a product is its marginal cost. Expensive fixed costs like your R&D, manufacturing, or CEO compensation are not taken into account. However, it forms the basis of the fundamental theories of pricing and supply and demand in textbook economics. Therefore, over time, production increases and prices decrease until they are equal to marginal costs. However, software ruins it. Because practically everything in the realm of software has a marginal cost that is as close to zero as is irrelevant. There is no marginal cost associated with creating a Facebook account, downloading an app, or reading anything online. This means that they can be provided for free, and they commonly are, with the fixed production expenses covered by donations, sales of products, or other unofficial revenue streams in addition to advertising. Although we can't predict what the coming decade will bring, it's tempting to believe that the enormous technological revolution brought on by the development of AI will negate the significant economic shift brought on by the death of the two zeros. These two economic realities profoundly shaped the past IT boom. How will the next one develop without them? Again, the straightforward explanation of economics is that the marginal cost establishes a price floor. If a product is sold for less than it costs to produce, the business would fail very soon. And after you've spent the fixed cost of producing your product, selling more of it at any price higher than the marginal cost is always worthwhile. What do you think about all this? If you have some experiences to share, talk all about it in our comment section. For more interesting stories, subscribe to our channel, and don't forget to press the bell icon for notifications. Goodbye.